Let me ask something else, Bob. Let's talk a little bit about the stock market and its reaction or lack thereof to the tightening cycle. What explains that? Should the Fed have done more on the balance sheet side if we wanted to see a reduction in stock prices and risk assets overall? And would that have even been desirable, do you think?
From the Fed's perspective, the financial conditions are not particularly tight. I understand that the Fed and various people will say financial conditions are tight, but when you have stocks, rapidly appreciating and you have spreads at all-time lows, financial conditions are not tight. And so the outcome that they got was a function of the fact that they didn't do much, or they weren't particularly aggressive in selling financial assets, which would have had knock-on effects through the financial markets and in particular the stock market, and left those assets to continue to appreciate while, claiming that they were worried about inflation and raising interest rates. And so, those two levers, the interest rate lever, because of the fact that the income growth is the primary driver of economic expansion, the interest rate lever wasn't all that effective. And the asset selling lever, which would have been much more effective, or at least much more direct in terms of helping create a drag on economic activity, they just didn't do enough relative to all the other pressures, which is frankly, strong nominal GDP, strong financial conditions, low spreads, et cetera, all reflective of the fact that the economy was pretty strong, just overwhelmed what the Fed was doing, which was a relatively modest contraction in money supply relative to the other pressures that were in place.
Do you think this is a lost opportunity to try and further normalize the balance sheet? Is this also evidence that they don't really care to normalize it?
The balance sheet is probably best thought about as a combination of a tool of monetary policy and a macroprudential liquidity mechanism. And on the macroprudential liquidity mechanism, we went from a period of time, back pre-financial crisis, where there probably wasn't enough liquidity available for the banking system to, today we're, banking reserves and liquidity for banks is in pretty good shape.
I mean, they had to change from a corridor to a floor system in part because of the size of the balance sheet and the ampleness of reserves.
That's exactly right. And part of the story is if all the reserves are captured by one particular bank or a small number of banks, you can have, unequal distribution. And so part of the dynamic there is you essentially have to have a lot more liquidity so that you can have the vast majority of banks have a strong liquid position. And so it might look like the balance sheet is essentially too big relative to the liquidity needs, the sort of net liquidity needs of the system. But, only now sort of at this level can the Fed, I think, basically say that the vast majority of banks have the liquidity that they need. And so that kind of puts a floor on what's going on with the balance sheet, that the balance sheet's going to be big relative to where it was, pre-financial crisis. That's all there is to it. And then within that, they can use the balance sheet on the margin to manage monetary policy, which I think their goal here, or their belief, is that interest rates are a much more effective tool at managing monetary policy than our balance sheet shifts. I don't think that that's true. Obviously the quantities and sizes matter in terms of exactly what you're talking about. But in a highly financialized economy, financial asset prices are a meaningful driver of economic activity and essentially the choice for households and businesses between saving and spending. And so it seems to me that the balance sheet would have been a much more effective tool than interest rates, but they don't see the balance sheet as a meaningful, effective tool of monetary policy. And so simply have, discarded that lever, particularly from a tightening side.